So today I want to review the big question, where is the real estate market headed? And I want to go over all the data in detail so you can make your own personal decision on what's going on in this real estate market here locally in Palm Beach County. So the first data point that I love to track is the average sale price data. If you compare January of 2023 to January of 2022, we've seen a 28% increase in sales price. Now that doesn't sound too bad, does it? This means homes are worth on average 28% more today than they were last year at the same time. Now we just have to be a little careful here. By looking at one data point and making a decision on what the market's doing would probably be a little irresponsible. So if we look at the graph that shows the trend line for the average sale price data, you'll see that June of 2022 was the peak pricing. Now, the market has dropped since then by 6% in Palm Beach County. So values have declined 6% since June of 2022. While the 28% year-over-year data point is helpful, it doesn't tell the whole story. What will help more is the trend line. Let's take a look at the trend line. You'll see that here in June of 2022, that was the peak of the average sale price in this market. Since then, property values have declined by 6% on average. The other thing to point out in this trend line is that December was significantly lower in average sale price numbers than January. So we'll have to see what happens here in February once the data prints to understand better what is happening in this market. So when you look at this trend line, there's a little bit of confusion here, right? Since June of 2022, we've seen a 6% decline in the average sale price if you're looking at the January printed numbers. But if you just compare it to the December printed numbers, so June of 2022 compared to December of 2022, we've seen a 20% decrease in the average sale price. So this is very different. And so we need to watch what's happening here in January, and we need to look at some forward-looking data points to understand where the market's trending to have a better understanding of what's going to happen February, March, and April. Here's what has me concerned. While we've seen an increase in the average sales price data for January of 2023 as compared to December of 2022, I still am a little worried that because December's numbers were so low, that February might print lower than January and continue the downward trend. Now let's take a look at the original sale to list price ratio. This, simply put, will tell us if properties are selling for close to what they're asking for or below what they're asking for or above. As you might expect, homes are selling for less than what they're asking for today. This wasn't always the case. Let's look at the trend line to understand where we're headed. Okay, so March, April, May of 2022, homes are selling for basically on average what they were asking for. I know personally I was selling homes for over asking price a lot in that time frame. But now they're selling for 8% less than what they're asking for. That is a signal that the market is softening. But one thing to remember here is let's look at the 5-year trend line. 5-year trend line shows that on average, homes typically sell for 8% less than what they're asking for. So this feels like an average market. We're getting back to some norms. So that is a good thing. It's important to mention that all the data here that we just reviewed is considered a lagging indicator. Why is it a lagging indicator? Because it's all sold data. Homes typically take 1, 2, 3 months to close after a contract is signed. So the data we just reviewed is backward looking by about 1, 2, or 3 months on average. A good way to understand if our market is slowing or accelerating is to look at the average days on market data. This will tell us if homes are sitting on the market longer or taking longer to sell. If we look at the year-over-year data, January 2023 as compared to January of 2022, we've seen a 66% increase in the average days on market. This is a signal that the market is slowing down. Now, if we look at the days on market trend, we see that every month it's taking longer for homes to sell. And I would expect that to happen going into February, March, and April. I'm personally feeling that on our listings as well. So I would expect days on market to continue to increase here into the future. I found something interesting digging a little deeper into the average days on market data. So if you look at the 5-year trend and you look at what was normal before 2020, you'll see that most homes took about 80 days to sell. So from my perspective, 53 days on market, that's not so bad, even if it has increased 66%. But also something to consider is that we're likely headed back to that normal market, so we will likely see 80 days on market in the future here. So keep that in mind if you're a seller or a buyer. Now let's discuss the number of listings graph, which helps us understand what current and anticipated inventory will look like in the Palm Beach County real estate market. In January of 2023, 40% less homes sold in the Palm Beach County real estate market here than last year at the same time. Here's a quick fact that I found from digging a little deeper. We haven't seen home sales this low since March of 2020 when COVID was in full effect and lockdowns were in place throughout the country. This is another lagging indicator, but this is a huge signal that things are changing in our real estate market. Let's take a look at the current inventory on the market. As of February 1st, we're seeing a 90% increase compared to the same time last year. I'm not super concerned about the huge inventory increase, at least at this moment, because we are still 41% below what the inventory was in December of 2019. So for all you buyers and sellers out there trying to think about where the market is headed, if we think we're heading back to norms pre-COVID, well then we got a long ways to go before we hit December 2019 inventory numbers, but we may be heading in that direction and it's starting to look like it is. And here's another interesting data point from the number of listings chart. 22% less homes went under contract in January of 2023 as compared to January of 2022. That's a signal that demand is slowing up. The properties that went under contract this month will be our sold data in the next coming months. So under contract data, pending data is considered a leading indicator. Something that I think is worth mentioning real quick because I think there's some confusion around it is when you see a pending listing on the MLS, on Zillow, on Realtor.com, the price next to that is likely not what the property is going to close for. It's likely not what the property is under contract for. As we discussed earlier, properties are typically selling for 8% less than the original ask price. Let's discuss absorption rate. Simply put, the absorption rate metric shows how long the current inventory will last at the current rate of sales. Based on the standard absorption rate calculation, the absorption rate is now 3.48 months, which is substantially higher than a year ago and is steadily increasing. If we get into the weeds again and we look at the 5-year trend, you'll see that the absorption rate has historically been somewhere in the 5-month range. So if we think we're heading more towards an average market, we're likely going to see the absorption rate of 3.48 increase to somewhere in the 5 range. Here's the deal though. The standard way to calculate the absorption rate is as follows. Absorption rate equals active listings divided by the average number of listings sold per month for the previous 12 months. That means that the absorption rate of 3.48 months that I mentioned earlier is using data from all of last year, which we know is a very different market than today. So that makes me question, is this number really helping us or really telling us something? Let's try something a little different. If we only use the January data to calculate absorption rate, then that math tells a different story. So this is the equation I use this time. Absorption rate equals active listings divided by the number of listings sold in the month of January. If you use that math, then the absorption rate is 6.09 months, not 3.49 months. That is a very different number. And that's what we're living in right now. We're living in January's data. So why not use January's data to calculate the absorption rate? Let's quickly talk about how the absorption rate is different in different price points here in Palm Beach County. Now again, I'm only using January's data here to give you these specific numbers. The absorption rate for the price point of $1 to $1.5 million is up to 6.93 months compared to 2.37 months from just last year. This is defined as a buyer's market. We are now entering a buyer's market territory at this price point. The absorption rate for the price point of $500,000 to $750,000 is up to 5.83 months compared to just 1.39 months last year at the same time. This is indicative of a neutral market. We are now in neutral market territory. The metric indicates that it will take 5.83 months to sell the 276 homes currently available on the market if the demand trend continues. When we talk about the absorption rate and what it means to buyers and sellers in the real estate market, we typically say that 6 months is a balanced market, below 6 months is a seller's market, and above 6 months is more of a buyer's market. Now let's consider how the mortgage rates are impacting our local real estate market. Rates are more than double than what they were at the same time last year. This has dramatically affected housing affordability and has definitely impacted demand in our real estate market. Since rates have gone up, there's been downward pressure on prices and demand has backed off quite a bit. So the big question now is, what are rates going to do? How are they going to affect the future of our real estate market? The first thing I might comment on regarding this topic is we still may not have felt the full impact of what was done last year with the interest rates increasing. What I mean by that is usually when interest rates increase, it takes some time for the real estate market to really price in those increases. And I don't think we've entirely priced in those increases. So we may still be feeling some downward pressure from what was done last year regarding the interest rates. The second thing I think we should look at, which I find pretty interesting, is the 30-year mortgage rate as compared to the 10-year yield. Typically, the delta between the 30-year mortgage rate and the 10-year yield is 1.79%. More recently, it's been 2.79%. So it's possible in the future that the spread could return to historical norms, which would mean that the interest rate for the 30-year mortgage will come down. Here's my crystal ball prediction. Interest rates have probably peaked at this point, and we probably can expect to see interest rates come down a little bit more here in the near future. Let me quickly show you a chart that depicts how much interest rates affect affordability and purchasing power. Now let's talk about the insurance market and how that absolutely has not helped affordability here in South Florida. I'm going to quickly quote the National Association of Insurance Commissioners so we can better understand what the heck is going on. The trend of paying up to protect your home is expected to continue into 2023. According to the Insurance Information Institute, premiums in Florida are expected to increase an average of about 40% this year, even though lawmakers in Tallahassee have approved sweeping reforms in a special legislative session last month. Well, that doesn't sound good. There's other things going on in the background, like it's harder to get insurance, there's less insurance providers in the area, but the big thing is insurance hikes like this have definitely impacted housing affordability in our South Florida market. Now let's talk new construction and population growth and how that's impacting our South Florida real estate market. More people have moved to Florida than any other state last year, making Florida the #1 fastest growing state in the country. The population in Palm Beach County has grown by almost 17% since 2010. Palm Beach County's estimated population in 2023 is 1.543 million residents. The population growth in Palm Beach County is growing by about 1.1% each year. There were permits issued to build 6,053 residential dwellings in Palm Beach County in 2022. So what's crazy is the pace of new construction doesn't even offset the population growth. And I think everyone that lives here agrees that there has definitely been population growth over the past few years and the past decade, and that definitely puts upward pressure on real estate prices. I quickly want to touch on the psychology of the real estate market in this current moment. So basically what I want to talk about is what people are thinking about as buyers and what people are thinking about as sellers and how that's impacting transactions today. I think as the real estate market has changed over the past 6 to 8 months and prices have come down and demand has slipped a bit, I think there's been a bit of a disconnect between sellers and buyers regarding pricing expectations. A lot of sellers that I work with, I think, have had a hard time coping with the fact that the peak of the real estate market is behind them, and they typically want to price their home based on comps from June or early 2022. While buyers, on the other hand, it's been my experience, they're acutely aware of the changing cost of ownership because they're speaking with their lender, they're speaking with their insurance provider while they're shopping for a home. And another thing I've noticed in this current market about the buyers is that they're becoming more and more aware as time goes on that they have greater negotiating power. And also they're becoming more concerned about overpaying for a property, so buyers' offers are coming in more conservative right now. I think the disconnect between buyers and sellers regarding pricing expectations will work itself out as we hit a steady state in the market, and maybe that'll happen towards the end of 2023. And it's been my personal experience a lot of times that when buyers look at overpriced property, they typically just don't make an offer. So when buyers work with us and listen to our coaching and they make offers at fair market price for overpriced property, when the seller eventually changes their mind to accept an offer at fair market price, we'll be one of the first phone calls before they even reduce the price on the listing. And now my recommendation for sellers that we work with is to understand the market data that we're discussing here and try to price at a justifiable number. This will drive a ton of traffic because there still is good demand in this market. And what will happen when you drive a lot of traffic to your listing is you typically sell for above fair market value for your property because you're the only one or one of the very few that's on the market and priced reasonably. As I mentioned earlier, a lot of sellers right now in this market are still looking for that June 2022 number, and it doesn't exist in this market anymore, but a lot of sellers are doing that. So when you price fairly in this current market, you get all the traffic because you're one of the few on the market that's priced at a number that makes sense. The pricing data that we discussed shows that properties have retained some of the gains they've made over the past 2 years, but now prices are coming down. It's becoming more and more obvious day after day that buyers are starting to have more negotiation leverage, more options on the market, but inventory is still lower than it was compared to pre-COVID times. For example, in December of 2019, we had a little over 15,000 homes on the market. That's 1.7 times the amount of inventory that we have today. And further support for a buyer's steady state market is the fact that the absorption rate continues to climb. And I believe and predict that it's going to push us into more of a steady state and possibly even a buyer's market as we progress here into the summer months. But when we're looking at the average days on market data, the data of 53 days on market for Palm Beach County does not really sound like the world is ending or the bottom is falling out. So my prediction for what days on market will do going forward here is that we'll continue to revert to what historical norms were, which were about 80 days on market. So there's still some room to go, and I think we'll continue to see days on market increase here as we enter the summer months. Despite all this data suggesting that the real estate market is softening here in Palm Beach County, I do think we have two really good things going for us down here, which is one, healthy population growth, and two, low inventory. I think these two fundamentals will keep us in a strong, healthy real estate market for years to come. I think the fact that there's little space to build new residential product here in South Palm Beach County and Palm Beach County in general is a key factor in why I think the inventory will remain low here in years to come. Plus, I think the population growth has climbed at 1% plus per year for the past 10 years, and I don't see any reason why that would change here in the coming years. I also truly believe that it's a good thing that our market's cooling off a little bit, and I still believe that there's a little bit more cooling off left to do here before we hit steady state. As I mentioned earlier, we're still a little ways off from those average market conditions we were experiencing prior to COVID. Now, the fact that there was a recent drop in interest rates combined with the fact that we are in the selling season here in South Florida will likely help sellers and put upward pressure on pricing over the next couple months, but I'm very suspect of what will happen here in the summer months coming.